Welcome to this episode of PhillipCapital's Market Watch. I'm Miaomiao, a research analyst from Phillip Securities Research. Today, I'll be presenting on the market outlook on the Singapore S-REIT sector, focusing on its recent performance and our subsector preferences. In July, SREIT Index rebounded, recovering by 5.4% after a 1.8% decline in June. Prime US REIT was the standout performer, surging by 62.4% due to successful refinancing of its main credit facility, which alleviated investors' concerns about their financial stability. On the other hand, Daiwa House Logistics Trust was the worst performer, declining by 1.8% due to the weakening Japanese yen, which eroded distribution per units for investors. Sector-wise, the overseas commercial REIT subsector led, gaining 26.6%, driven by strong performance in the U.S. office sector. Conversely, the hospitality subsector had modest growth of 2%, impacted by global moderation in revenue per available room growth. S-REIT are trading at forward dividend yield of approximately 6.1%, slightly above the long-term mean by 0.1 standard deviations. The SG 10-year bill fell by 43 basis points month-on-month in August 2024, while the 3-month SORA rose by 1 basis point month-on-month. This resulted in a 3.2% spread between S-REIT forward dividend yield and SG 10-year bond yield, making S-REITs a more attractive investment. Given the Fed's recent dovish stand, we believe this is an opportune time for investors to reposition their portfolio into S-REITs. S-REITs are currently trading at a price-to-net asset value of 0.89 times, 1.6 standard deviations below its long-term mean of 1.03 times. The price to NAV has increased by over 10% in the first half of 2024. We expect this upward trend to continue as the market anticipates interest rate cuts and their positive impacts on portfolio valuation and risk performance. As fundamentals improve, we anticipate a further narrowing of the discount to NAV. The first half of 2024 results for S-REITs under our coverage met expectations, with most S-REITs reporting year-on-year decline in distribution per units, averaging around a 12% decrease due to higher financing costs, with the market now pricing in at least 3 Fed interest rate cuts in 2024, up from only 1 projected in June. We expect S-REITs to outperform in the second half of 2024 into 2025. Lower interest rates are likely to benefit S-REITs through reduced financing costs, higher dividend yield spread over bonds, and higher property valuations as capitalization rate compress. If 3 rate cuts occur in 2024, we anticipate DPU growth returning in 2025, driven by REITs adopting lower interest rate hedging or fixed rate ratios. Additionally, we expect asset transactions to pick up as interest rates soften. For sector picks, we are overweight on retail and hospitality subsector. Rental reversions in the first half of 2024 were robust across the Singapore retail REIT sector. Fraser Centrepoint Trust and CapitaLand Integrated Commercial Trust performed strongly in suburban malls, with rental reversion of approximately 7.5% and 9.1% respectively. Downtown malls experienced even more significant rental growth, with Suntec City Mall, OUE REIT's Mandarin Gallery, and Paragon Mall achieving rental reversions of 20.8%, 28.4%, and 21.6% respectively. Retail portfolio occupancy across the S-REIT remains strong, constantly above 95%, despite some downtown malls reporting slightly lower tenant sales year-on-year in the first half of 2024. Landlords noted that tenants are still willing to pay higher rents given the strong outlook for tenant sales. Shopper traffic improved by an average of 4% across REIT-owned malls in Singapore. We expect positive rental reversions to remain at similar levels for the full year of 2024, driven by the limited supply of new retail space. In the second quarter of 2024, RevPAR continued to improve for the REITs under our coverage, even against the higher base set in 2023. CapitaLand Escort Trust reported a 4% year-on-year growth in the portfolio RevPAR, reaching 102% of the pre-COVID levels. Far East Hospitality Trust achieved a 6% year-on-year increase in hotel RevPAR, as average daily room rates begin to moderate from the high growth experienced in 2023. Driven by pent-up travel demand, we anticipate future RevPAR growth will be driven primarily by higher occupancy rates. Singapore's international visitor arrival increased by 13% year-on-year in July 2024, reaching 1.6 million, or 89% of pre-COVID levels. Notably, visitor arrivals from China surged by 79% year-on-year in July 2024, now standing 6% above pre-COVID levels, following the implementation of 30-day visa-free entry for Chinese citizens in February 2024. Looking ahead, we expect RevPAR to continue to grow in the second half of 2024, bolstered by the high-profile concerts and Singapore Formula One Grand Prix and the packed schedule of MICE events. I hope the insights shared today will benefit your risk investment journey. If you have any questions, feel free to reach out to our research team or me. This concludes this episode of PhillipCapital's Market Watch. Don't forget to like, follow, and subscribe for more updates. Thanks for joining us.